Right, the benchmark prime lending rate may be a thing of the past soon. That's because the Reserve Bank of India is all set to deregulate all lending rates in the next fiscal. More importantly, the Mint reports today that a base rate is likely to replace the Bplr and no bank will be allowed to offer any loan below that base rate.
To understand the ramifications, we are joined by Mint's Tamal Bandyopadhyay, who broke that story this morning, RBI's Bplr committee member TT Rammohan, and our own Latha Venkatesh.
Tamal, let me start this conversation with you first. Is deregulation of lending rates the next big reform move in the Indian banking sector? How do you think this will be approached?
Yeah, definitely. Of course, it's a very significant development, and you call it reform on whatever you want. But the fact is, historically, in so far, lending rates are deregulated, but in quite a few critical segments like export credit, like all the so-called priority sector lending, which is 40% of banks' loan book, they are mandated. While export credit cannot be priced, or rather should be priced at 2.5 percentage point less than a bank's prime lending rate. The other loans, all to agriculture, to small-scale industries, and to the so-called weaker sections of the society, which is 40% of a bank's book, the rate on those loans cannot go beyond a bank's prime lending rate. So Reserve Bank of India is ready to free all these loan rates. So definitely it's a very, very important, significant happening in the banking space.
Professor Rammohan, you were part of that panel. What was the thinking of the panel in terms of a recommendation made on the options that were considered before arriving at how this base rate could be calculated?
Well, I think the report that we brought out has highlighted many of the problems we had with the earlier system. There were three main problems with the earlier system, which is based on the base prime lending rate. The first is that rate was not adequately responsive to changes in monetary policy. So the RBI would cut its policy rates and you would not see that transmitted into lower lending rates. That was the first problem. The second problem was what borrowers thought was a certain lack of transparency in the system, because people got all kinds of discounts to the Bplr, and it was not always clear that these rates which were offered to people were necessarily risk-related. That was the second problem. And the third problem, which sort of Tamal mentioned publicly, is that because you had fairly high rates coming from the Bplr system, it was felt necessary to support particular sectors, exports, small scale, weaker sectors and so on, through administered lending rates. And therefore, the need was felt to come up with a system which would take care of these three problems.
So, Mr. Rammohan, whatever you've heard Tamal say, does it appear likely that this is something that could be a reality very soon?
Well, certainly I think I can't comment on what's going to come out, but certainly I think in the report we have asked for deregulation of various rates, but subject to certain safeguards. I mean, in the case of exporters, you can't charge more than the base rate. In the case of education loans, there is a band of 250 basis points above the base rate. But subject to these safeguards, there will be substantial deregulation of interest rates if the recommendations of the committee are accepted. And as I said, it becomes possible to deregulate interest rates because finally the rates will settle at a level which will be generally acceptable to all these sections. So the great fear with deregulation always is that the rates will spiral out of control and exporters will be hit, small scale will be hit and so on. But the method of computation has been devised in such a way that if anything, the rates should settle at lower levels than today. They shouldn't really go up.
All right, let's go across to Latha now. Latha, how are you reading this move by the RBI?
Well, actually, several problems with what has been mentioned. One, in the first place, whether there will be political will to go through all this kinds of, deregulating rates even for small-scale industry and agri. Assuming that, as Professor Rammohan says, if the base rate is low, that may not be a political problem, that could be overcome. The second point that Tamal is raising about deregulation of savings rate, there is a huge lobby against it, and that's the bankers themselves. If savings rate is deregulated today or tomorrow morning, I assure you the savings rate will go to 5% because there is a clamor for that cheap deposit, and a lot of private banks will be willing to pay even 5% for that. And if 1% pays 5%, there is no reason why someone else can be left behind. So there will be a rise. Now, will the Reserve Bank and the banking sector and the government, as the major owner of the banking sector, allow that deregulation? It is very, very pro-customer, no taking away from that. But it's a very big change. It will squeeze bank margins to such an extent at a time when, there is a brouhaha all over the world about conserving bank capital, making banks stronger, because in the inevitable slowdown cycle, which is certainly not played out just yet, there will be more NPAs. This proposal, which is long overdue, may not be rushed in a hurry. So, liberation of savings rate, very welcome for the customer, but I'm not sure that the vested interest will allow it just yet. There is also a note that Tamal makes that the base rate may not be linked to the deposit rate. Now, according to me, and Professor Rammohan can correct me, that is the primary suggestion of that committee, that every time it should be, the base rate should be linked to the deposit rate. The 1-year deposit rate is what they have recommended. And every time you cut 1-year deposits, cut lending rates as well. Every time you hike deposit rates, then hike lending rates as well. A very neat connection that the committee has made. When your cost of money goes up, you're allowed to charge the customer more. When your cost of money goes down, pass it on. But there is a lot of opposition to it, and from what Tamal has explained, that will not happen in the base rate. If that doesn't happen, I don't see how the base rate is going to be very effective. Without that consideration, existing customers can be charged differently from new customers, so the whole argument falls. I mean, I have my trepidation about that, the way in which that base rate will be implemented.
Let's bring Tamal in here, Latha. Tamal, what do you think the implications of this move will be on banks? That's the point that Latha raised first. How do you think they will be affected?
Well, Harsha, I think that's very critical. I think all the banks have, started looking at the numbers, and it's on the drawing board. The most important impact it could have on their NIM, net interest margin, on the cost of money and the earnings on that money which the banks make. Now, at this point of time, I don't think there's a very clear picture, but I think as long as savings rate is not deregulated, which means which is on the liability side, which they will continue to pay 3.5%, there won't be much of an impact because they will earn more on these loans at this point of time, when the private sector loans and export loans marginally more than what they have been earning. But at the same time, because they will be forced to bring down their prime lending rate, so their other earnings on other loan, the rest of the loan book will go down. So I think it will be a balancing factor. There won't be neither negative nor positive at this point of time. It could be a bank specific, but definitely public sector banks will be an advantage, because all these norms are particularly in regard to the public sector banks. They have been used by the government and Reserve Bank of India to dole out the money at a concessional rate to various segments.
Well, actually, let me get Professor Rammohan in, since he was part of the base rate or the Bplr revamp committee. Professor Rammohan, would you agree that savings rate liberalisation will happen so quickly? That was not quite part of your report. And secondly, if the base rate is not linked to the deposit, either 1 year or any deposit rate, doesn't it mean that your report has not been implemented at all?
Well, to answer your first question, I mean, certainly if the savings rate is deregulated over time, it's bound to have some impact on the net interest margin, you're right. And there I think the question is one of timing. When do you want to do this? And my own sense is that perhaps now is not the most opportune moment to do that. Once we have a full-fledged recovery, and we are clearer about the NPA situation, let's say the economic growth goes up to the level of 8 to 9%, then perhaps that is the point at which the RBI can consider this, because even if the NIM, the net interest margin, is squeezed, the overall profitability of banks may not be significantly impacted. So I think now is perhaps not the best time to do that. Now, as for your other question as to what will happen if the RBI doesn't implement that particular recommendation of ours, which is to link deposits to, the base rate to 1 year deposit rate. Now remember that there is a safeguard built in there in the report, which is that the proportion of sub-PLR loans cannot exceed 15%. Now once you have that condition, even if banks are given the freedom to use whatever benchmark they like and not the 1-year deposit rate, that freedom could turn out to be notional, because if you're going to use, say, 2-year rates or 3-year rates or historical rates, you may not be competitive in the market. So, yeah, so the RBI could say that you can use a 1-year deposit rate or anything else as a benchmark, but I doubt that banks will have an awful lot of freedom on that account, because they will not be competitive. And they can't price more than 15% of the loans as sub-Bplr rates, so that is going to limit the room for maneuver of banks. So, by and large, if you have some players who are going to use the 1-year deposit rate as a benchmark, and I'm sure there will be some, then more or less the system will be forced towards that. Right. I can't see that banks will have much of a choice.
All right, Mr. Rammohan Roy, we'll leave it there. Thanks very much, Latha. Thanks very much, Tamal, as well, for getting us that perspective on this big development that is likely to unfold in the coming months. Interesting perspective from all three of you. Thanks very much for joining us. Coming up on What's Up.
Whenever there was